In 1720, the smartest people in England lost everything. And they saw it coming. Here's the story everyone tells. A bunch of gullible investors got swept up in hype, threw money at a company that didn't exist, the stock collapsed and fortunes evaporated. It's a cautionary tale about greed and ignorance. The problem, that explanation lets the actual architects of the scheme off the hook entirely. Because the South Sea bubble wasn't an accident, it was engineered by people who understood exactly what they were building. The South Sea Company was chartered in 1711 as a trading venture. Its pitch was simple: we'll monopolize trade with South America, make enormous profits, and shareholders will get rich. But here's the thing, the company barely traded anything. What it actually did was refinance government debt. Britain owed money from wars. The South Sea Company bought those debts at a discount, and the government paid them back at par. That spread was the entire business model. For a decade this worked fine. The company was profitable, dividends flowed, investors were happy. But around 1719 the directors got ambitious. They proposed to absorb even more government debt, roughly half of all outstanding British debt. In exchange, Parliament would grant them a monopoly on trade with the Spanish colonies. Nobody in this story is stupid. Look at what they were paid to see. If that monopoly materialized, the company's valuation would skyrocket, stock prices would follow. The pitch worked. Parliament approved it in 1720, and immediately stock prices began to climb. Not because the monopoly had materialized, it hadn't. Not because the company had proven it could execute, it hadn't. But because the directors started actively managing perception. They hired brokers to buy stock, driving prices higher. They leaked optimistic reports. They offered credit to new investors, so people could buy on margin without cash. Here's where it gets interesting. The directors weren't just manipulating outsiders, they were cashing out themselves. As prices rose, insiders sold shares quietly. They converted their holdings into cash and property. They bought estates, funded lavish homes, and secured their wealth in assets that couldn't collapse. Meanwhile, ordinary people, merchants, widows, clergymen, servants, poured their savings into stock at artificially inflated prices. By June 1720, South Sea stock had climbed from around £130 to over £1,000 per share. The company's market value exceeded the entire wealth of England. Mathematically it was nonsense, but prices don't move on mathematics, they move on belief, and belief was cracking. In August, the first major insider, the company's accountant, sold heavily. Rumours spread. A few large shareholders liquidated positions, the psychological dam broke. Suddenly everyone wanted out. But when everyone's selling and nobody's buying, prices don't just fall, they crater. By December, stock was trading below £200. Fortunes that existed on paper in July had vanished by autumn. Estimates vary, but somewhere between 100,000 and 500,000 people lost money. Some lost their life savings. A few lost their minds. Suicides were reported. The government launched investigations, directors were arrested, some assets were recovered and distributed, a pittance compared to losses. But here's the crucial part: almost nobody who engineered the scheme faced serious consequences. The directors had already moved their wealth. For decades, historians blamed the bubble on public stupidity and speculation mania. But that's not what the evidence shows. What it shows is a deliberate campaign by sophisticated operators who understood market mechanics, used information asymmetry, and extracted wealth before the structure collapsed. They didn't get lucky, they got out first. The real damage wasn't financial, it was institutional. Trust in markets evaporated. For decades after 1720, English investors avoided stocks entirely. Companies that actually needed capital to expand couldn't raise it. The bubble didn't just hurt individuals, it set back economic growth across an entire nation. But there's a second, stranger consequence. Governments learned something from this disaster. They realized that bubbles were predictable and that insider selling was a leading indicator, so they started implementing rules, disclosure requirements, restrictions on insider trading, margin limits, rules against price manipulation. Most of the financial regulation you know exists because of 1720. The South Sea directors didn't invent fraud, they invented the template. And regulators have been playing catch-up ever since. Every few decades, someone finds a new angle. Different asset class, different mechanism, same incentive structure, extract value before the structure collapses. The names change. The pattern doesn't. What makes the South Sea story relevant isn't that it happened 300 years ago. It's that the incentives haven't changed. Information still moves faster to insiders. Insiders can still exit before outsiders see the exit door. And as long as those asymmetries exist, bubbles will form. The only variable is what asset gets inflated next and how long the cycle lasts. The lesson isn't don't invest or markets are rigged. Those would be advice, and that's not what this is. The lesson is structural. When you see prices disconnected from fundamentals, when insiders are selling while they are publicly bullish, when enthusiasm is high but transparency is low, you're watching a pattern repeat. The South Sea bubble didn't teach us how to avoid bubbles. It taught us what to look for when we're inside one. And that's the real revolution the South Sea bubble sparked. Not new technology or new markets, but a new awareness that financial systems need friction built in. They need rules that make insider extraction harder. They need disclosure that closes information gaps. They need mechanisms that slow down hype and speed up reality. Most of modern finance exists because 300 years ago, a bunch of smart people figured out how to steal from everyone else. The South Sea directors won. They extracted their wealth and faced minimal consequences. But in losing, the public accidentally forced a system redesign that made it harder, not impossible, but harder for the next wave of insiders to pull the same play. The bubble collapsed in 1720. The lesson is still inflating. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe. Each week we uncover how fortunes are actually built and lost, and why the mechanics never really change. This video is for educational and informational purposes only and is not financial advice. Always do your own research.